Welcome to Finsight Updates YouTube channel. Today we are going to discuss about the accounting treatment of stripping cost in open pit minings. Overview of stripping cost. Open pit minings where ore is extracted through progressively larger and deeper pits involves significant stripping cost related to removing overburden and waste rock. Development phase. There are two phases. One is development phase and another is production phase. Development phase is otherwise known as pre-production stripping, where costs are incurred to access the ore body before production begins. In case of production phase, which is known as post-production stripping, costs are incurred during mining operation as ore extraction continues. Accounting treatment in both the cases. Accounting treatment in case of pre-production stripping, it is a well accepted practice to capitalize pre-production stripping cost as part of mine development expenditure. It is very simple. In case of post-production stripping, accounting treatment will varies. Normally, two accounting approaches are applied. One is immediate expense method, second is deferred cost method. In case of immediate expense method, costs are expensed as incurred, and this method is applied when stripping ratio remains relatively constant throughout the life of the mine's component. In case of deferred cost, costs are deferred when actual stripping ratio exceeds the approved or expected average. These deferred costs are later amortized when stripping ratio falls below the expected average. And this method is applied when stripping ratio fluctuates significantly across different periods. The basic difference is that where two accounting method is applied, one case where OB to O ratio fluctuate significantly across different periods than deferred cost method, where stripping ratio is constant throughout the life of the mine's component, there is a we will follow the immediate expense method. Deferral and amortization. Post-production stripping costs like drilling, blasting, loading, hauling are accumulated and recorded in balance sheet under stripping activity assets. Amortization is carried out on a unit of production basis. If ore distribution is uniform, deferral is not required. Deferred costs are amortized through the profit and loss account using approved stripping ratio. The recognition criteria as per IND AS 16, Plant and Property Equipment, Appendix B, stripping activity cost. An entity shall recognize stripping activity assets only if following all criteria are met. 1. There is future benefits flow to enterprise by way of improved access to deeper level of ore body. There is an identified components of ore body. Cost is measured reliably. Let us discuss with a case study. Case study in case of Mines Limited. Fact of the case. Improved access. Mines Limited often access to deeper ore body through overburden removal. In case of identified component, ore body is identified as band 1 as a PTID. Measured cost. OB removal cost of rupees 7.5 crore incurred during FY25. This qualifies for recognition as a stripping activity asset. Measurement and depreciation. Initial measurement. Asset is recorded at cost. Subsequent measurement carried at cost less accumulated depreciation or amortization. Amortization basis. Unit of production method unless other method is more appropriate. Calculation of stripping activity asset. Suppose there is an approved mining plan of band 1 that up overburden removal 11 lakh metric ton, chrome ore extraction 3 lakh metric ton. The average OB to ore ratio, which is otherwise known as the approved stripping ratio, is 3.67. Then we will compare with the actual performance. FY25, take an example. Overburden removal, actually overburden removed, 2,54,807 metric ton. Ore extracted, 30,800 metric ton. Actual OB to ore ratio is 8.27, which significantly fluctuate during the life of the component. Hence, we are going to defer this cost. Then calculation how much will go for the deferral. Total OB removal expenses 7.38 crore, expensed immediate 3.28 crore because 7.38 is incurred to extract overburden of 2.5487807, which is get multiplied by 11 lakh. It is coming around 3.28 crore. Deferred to balance sheet 4.10 crore, recognized as stripping activity asset, and this deferred amount to be amortized in future periods as actual ratio align with the approved average ratio. I hope this video is very useful, and to get the more video like this, please subscribe and give your comment in the comment box. Thank you.